This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest edition of the AJ Bell Money and Markets podcast. I'm Dan Coatsworth. Thank you for joining us today. So on today's podcast, we're going to be talking about takeovers. We've got lots of news here around deals involving Royal Mail and Anglo American. We've also got some indicative names that might be moving in or out of the FTSE 100 and the FTSE 250 as the index providers as its quarterly reshuffle. We'll also be looking at the latest figures from Finsbury Growth and Income and how Nick Train once again is perhaps trailing the market. Joining me on the podcast this week is Charlene Young. Hiya, Charlene.
Hi, Dan. And yes, with the general election called, that could mean some changes or not for the state pension. I'll speak to our Director of Policy, Tom Selby, about some really interesting research we've done on state pension ages. And three's a charm. So we've also got the thoughts of the Shares Magazine team on AstraZeneca. And I've done an interview with Wealth Wizards CEO Ben Hampton on all things advice in the advice gap. So we'll jump straight in with a market update. As in the most recent episodes of Money and Markets, we've been spoilt for content with the FTSE 100 breaking records and, of course, the market reaction to that election. But Dan, what's been happening in the UK and global markets over the past week?
Well, it's not been amazing. We've had the S&P 500 in the America down about 1% a week, FTSE 100 in the UK down about 2%. And in both situations, it's just the usual story. Expectations for when central banks are going to cut interest rates keeps getting pushed back slightly. Inflation is coming down, but it's still looking quite sticky. And I think there's just enough figures just about the general economy, which is just making people think, well, these central banks, they're looking for evidence that, the monetary policy needs to be looser, and they just don't have enough data to warrant making any sort of big changes to current interest rate policy. So, we're recording this on Thursday. Friday, by the time you hear this podcast, we'll have had some figures out on US inflation data, because that might change the narrative a bit depending on what comes out. But overall, I just think we had a pretty good run this year, but a little pullback at the moment. So let's just wait and get a bit more information, a bit more of the most latest economic data points, and investors could then sort of make a decision as we sort of move into the summer about what they want to be doing with portfolios. But what we do know is that the UK market in particular keeps being seen as very cheap. Everyone knows it's cheap for ages, but we're getting a lot of takeover activity. And we've had some update on Royal Mail owner International Distributions Services. I cannot believe it. Company has called its name that. Such a bad name. But they've had a takeover bid, and Charlene has got all the information for you.
Yeah, so something we covered a couple of weeks ago. Now, the first hurdle has been cleared in Daniel Krasinski's attempts to buy the owner of Royal Mail with that rather functional and awful name, and that's for £3.57 billion. Now, that price has been agreed and recommended by the Board of International Distribution Services, but the next step is going to be getting the government to approve the deal. Now, Jeremy Hunt had suggested the takeover wouldn't be opposed, but given the time they often take to complete, and if we're to believe the latest polls, it could fall to a Labour government to be the ones to decide. Now, Shadow Business Secretary Jonathan Reynolds has welcomed assurances that the proposed new owner will respect Royal Mail's history and tradition, and they've offered a series of undertakings so as not to rock the boat with the UK operations. Now, Labour says it would take the necessary steps to kind of safeguard its undeniable identity and place in public life. A really interesting point that I think you picked up was that the share price, just as we're recording this on Thursday morning, is 333 pence, so much lower than that 370 pence per share being offered by Kretinsky. Now, of course, that implies the market doesn't believe that this is a done deal yet, despite those promises to retain the brand, UK headquarters, UK tax residencies, all those key things which should appease whichever government is in power at the time. And it's almost exactly the same as that 330 pence price at which Royal Mail joined the stock market in 2013. So that could have been quite disappointing for long-term holders looking for appreciation along with dividends that have been paid along the way. So we'll, of course, be following to see if Kretinsky's deal does get the go-ahead, or should I say, stamp of approval. Apologies for that.
Yeah. I mean, God, the sort of headlines we've seen, people having a heyday, aren't they? It's the check is in the post, all those sort of things. But it's a bit of a chuckle. But yeah, it's interesting. Like I say, it's like trading below the offer price. But yeah, as always, we'll keep people updated on the podcast about what's happening. But of course, this is not the only takeover that's going on at the moment. Plenty of action going on. But one trend that we are seeing is for deals not going through. There's plenty of interest in UK stocks, but that doesn't mean to say that the first bid is going to be the one that seals the deal. Now, we've had BHP, the diversified miner, trying to buy Anglo American. It's come back with various sort of tweaks, twists and turns to its offer, but it basically just hasn't. It's not won it, not cut the mustard. So what's happened here is that BHP has just walked away and said, clearly, the proposal it made, which was very, very complicated, it involved demerging various bits of business. Paying all in shares, and it's just I think Anglo-American shareholders just look to go, crikey, this is about complicated as you can get. And I think fundamentally, if you just come out with a full cash offer, it would have had a much better chance. But I believe what we'll see here is that Anglo-American is incredibly attractive to other mining companies because it owns very large copper resources. So if you think that what's happening in sort of the energy transition in the world, so all this renewable energy, things like electric vehicles, all of these need lots of copper for all the equipment that that's powering these things. And so it's if you want to go out with a load of drill rigs and dig some holes in a mountain somewhere in random parts of the world, you even if you find something, potentially can take between 10 years from finding something to actually developing and getting a mine into operation and making some money from it. It's so much easier to just go out and buy someone else. So I think that Anglo's had a few issues over the years. It's a big business, but it's sort of lagged its rivals. So I think what we'll see here is that something like Rio Tinto or Glencore or Vale will just come along and say, like, here we go, we could probably offer a cash deal. This is what we're offering, and let's see if we can get it over the line. But like I say, that's not the only one to sort of collapse. We've had Revolution Bars was a bid target for Nightcap. That deal has also collapsed. Both those companies are going through really tough times. If you think the late night drinking market is just not what it used to be. Younger people don't really want to drink as much these days. Also, cost of living crisis is still there. Interest rates still high. It means people are watching their pennies, and the idea of splashing out on expensive cocktails is just not high up on their list at the moment. So that deal's collapsed. Wood Group, the engineer, has received 4 takeover bids from the same person. Hasn't engaged in talks for any of them. Definitely doesn't seem to want to be bought. So I wouldn't be surprised if that's that one sort of fades away as well. So yeah, lots of stuff going on. Reshuffle. So Charlene, let me just ask you. It's like, I know that your pensions is your favorite topic. Do you ever keep an eye on the FTSE reshuffle, or would it help me to tell you exactly what all this is about? Or
I think you're going to need, yeah.
This is where you confess to say, actually, you probably know more than me about the whole thing.
No. I did used to keep an eye on it, particularly when doing some staff training here at AJ Bell. But yeah, you're going to tell me, you're going to gen me up, I think, please.
So, I mean, once a quarter, FTSE Russell, which is owned by London Stock Exchange, they take all the big FTSE indices and they look at the market value of companies in it and then think, okay, we'll rejig things because each day the values of companies move up and down. And so things like the really big index like the FTSE 100 or the FTSE 250. So once a quarter we see, typically you see maybe a handful would fall out and you get some in the FTSE 250 handful get promoted into it. FTSE 100 you typically get smaller changes, so maybe one or two. So it's just released the list of indicative changes. So what will happen is that it's on the 4th of June is the big date where it looks at the data, and it'll make the announcement on the 5th of June about what the changes will be. So we're looking at Darktrace and Vista Group being promoted into the FTSE 100. Darktrace is interesting because it's in the middle of a takeover bid. So even if it gets promoted, it might not be in the FTSE 100 very long if that takeover goes through. Vista is the house builder, which is quite interesting because the property market is not really on fire at the moment. But actually, this company seems to be doing pretty well. Now, getting booted out of the FTSE 100 based on these sort of indicative figures will be Ocado. And that's not the first time this has happened. So, Charlene, are you an Ocado customer?
No, I mean, I do pop into sort of M&S Food and things like that, but I don't tend to use the kind of home delivery services that much anymore. There was a big fan in COVID, but not so much these days. But no, it's really interesting about the reshuffle, because I know of the last couple of reshuffles over the last year or so, we have seen some big names sort of fall out. But like you say, some two interesting candidates to kind of be introduced to the FTSE 100.
Yeah, I mean, I'm not an Ocado customer either, and I think lots of people think that's all it does is it delivers your food to you. But what it wants to do long term is to essentially power the sort of warehouses using its robotic systems for third party grocers. During COVID, when everyone's like, "Oh crikey," if you're a grocer and you don't have a really good online platform, you just kind of realize, we need to make that investment. So I think everyone was expecting Ocado to win loads of contracts, and it's won a few, but not many. And it does have a joint venture with Marks and Spencer's for the UK sort of delivery stuff, and that's not particularly doing that well. Certainly not as well as people think it could do. So Ocado goes through these sort of phases where everyone loves its shares and they rally, and then people go, "Oh, actually, no, it's not really doing that well." So it falls. It's probably the most volatile stock you can think of amongst the really big names in the UK market. But so anyway, that's something to watch coming up. I just wanted to also just mention about Finsbury Growth and Income. So this is an investment trust run by Nick Train. He's kind of one of the last remaining in the sort of the circle of star fund managers that are still active at the moment. So he's not been doing very well, and they've had half-year results out. It's underperformed the market yet again. And the talk certainly the talk in the office has been over the last few days. People are suggesting, "Oh, does this mean he's, the board will push him?" And it's saying like, "Enough's enough." Multiple years of underperformance. Is he going to get sacked? I don't think he will. He's not really changed his investment process over the long term. He's made really good returns. It's just he's not having a good run at the moment. But there's a huge debate here around, you pay a fund manager to outperform the market, and if they're not doing that, well, what do you do? Do you sit tight, or do you just go and buy a tracker fund? So what's your view on that, Charlene? Would you be patient and sit tight, or what's the point in which you go, okay, clearly something seems up here?
Yeah, I mean, like you say, he's not changed his investment process. He sticks to his guns, and like you say, he's one of those kind of like last big dogs. But it does reignite that debate, that passive versus active debate. What are you actually paying for? Now, won't deny, like you say, that he's delivered over the long term, but people might start putting him on notice, I guess, in their portfolios and having a watch and thinking about what they're going to do next, or like you say, whether they do switch over to a bit more of a passive strategy.
Well, we've had Nick Train on the podcast before. Perhaps I should put another request in to see if he wants to have a chat. So let's see what he says. So let's move on to some personal finance stuff. So what have you got up your sleeve, Charlene?
Yeah, so this week we saw the Conservatives floating the idea, or saying they're going to commit to a triple lock plus or quad lock. So that's the idea that anyone receiving the state pension will not pay tax. So if you think that that's someone's only source of income, with the frozen personal allowance is due to stay frozen until 2028. If the state pension increases each year with that triple lock, there's a danger that people will start to pay tax on their income. And actually, some people on the older style state pension, or those that have deferred, are already starting to pay tax on it. Now, with that in mind, we commissioned some really interesting research on state pension ages and what people know about their state pension age and what they think they know. So to kind of discuss this piece of research a little bit further, I'm going to bring in Tom Selby, our Director of Public Policy, to talk all things state pension age.
So that's right. Yeah, state pensions have been in the news in relation to the so-called quad lock. So this idea that we're not just going to have a triple lock for the state pension, but also the personal allowance for pensioners is going to go up. Pensioners is going to go up by the highest of average earnings inflation, or 2.5%. But we decided to do some research focusing on the other bit of the state pension. So there's the amount that you receive when you reach state pension age, and there's also the age at which you receive it. And we wanted to get a feel for just how much people understand the point in time at which they're going to receive their state pension. Now, clearly, the state pension for most people isn't going to be enough to fund their entire retirement, but it's a really important foundation for people that they're likely to build their private pensions on. So we asked 2,000 adults, so a representative sample, whether or not they knew their state pension age. So almost half of people who are under state pension age, so that equates to about 20 million people, said they don't know when they'll receive their state pension. Now, almost 2/3, so 63% of those aged 18 to 34, perhaps unsurprisingly, said that they didn't know when they received their state pension, and over half of 35 to 49-year-olds admitted they were also in the dark about when they'd received their state pension. Perhaps more worryingly, 28% of people who are aged 50 to 64, so people who are getting quite close to their state pension age, said that they were unaware of when they'd be entitled to their state pension. Now, if you dig into that a little bit further, actually, even though people say they know when they'll receive their state pension, some of them are getting it wrong. So if you look at that 18 to 34-year-old bracket, those people who say they know their state pension age say that it's 65. Well, actually, the current state pension age is 66. And by the time that cohort of people reach retirement, then the state pension age under current legislation is going to be 68. So if you get that into numbers based on a full flat rate state pension, those people are potentially underestimating how much they're going to need in retirement by somewhere between £30,000 and £35,000. That's the income they need to replace between a state pension age of 65 and a state pension age of 68. So a decent chunk of change there. And I think the thing that came out of this for me was just the lack of understanding and perhaps some communication issues for DWP around the state pension age. So clearly, in an ideal world, we want everybody to know when they're going to receive their state pension and how much it's going to be. And if people don't know when they're going to receive their state pension, or they're uncertain about it, then it makes it difficult for people to plan for the future. So I think there's a challenge for the government in terms of communicating when state pension ages are to different people. I'd say particularly to that older cohort, so those people who are approaching retirement, because it's a much more immediate challenge for those people. And I think going forward, we also need the government to be really clear about state pension policy, about what the state pension age is and what state pension age is going to be as well. And I think actually a lot of this stuff around the triple lock and the quadruple lock isn't particularly helpful, because these are policies that are focused squarely on a general election rather than something that's focused on a long-term strategy, a long-term agreement as to what the state pension should be worth and when people should receive it. In terms of what people can do today, so clearly the state pension age and state pension policy is completely out of people's hands, but you can check your state pension age. It's a really handy tool if you just Google, or the search engine's obviously available, but if you just search for check state pension age, then you'll find a government website where you can put your birth details in, and it'll tell you based on the current rules what your state pension age is currently set to be. Now, it's clearly possible that a future government will change that, but you can at least use that tool to give you an idea of what age you can expect to receive the state pension, and then you can plan around that.
Thanks to Tom Selby for coming on the show. So, Dan, I think you've got a couple of quick notes you want to share on what's happening with the NatWest share sale, or what isn't happening, and also a handy £100 bonus for nationwide members.
Yeah, let's start with NatWest. So, I mean, just over the weekend, there's just gone, there was sort of several newspaper reports saying that the government sort of paused its plan to offer a public offering of its holding in NatWest. So, if you go back to the credit crunch 2007, 2008, quite a lot of banks had to be bailed out. The government sort of took a big slice of NatWest, what it was then, it was Royal Bank of Scotland. So over the years, it's been gradually selling down, but it's still left with just under 27% of the bank. So it made an announcement a while ago saying at some point in 2024, it was going to sort of offer this to the public. And the expectation was it would probably have to do that below the market price to act as a sort of a bit of an incentive. So there's been lots of chatter that this was about to happen. Of course, then we've had the general election has been called. Of course, I think organising a sale of a chunk of NatWest shares is probably very low priority for the government at the moment. They're very busy campaigning. So there's this speculation that this has been paused. Now, whether this is just a case of being paused or not, or cancelled completely, and they'll just quietly sell little chunks in the market as they've done recently, we just don't know at the moment. But just to flag, if anyone's sort of expecting this to happen, there's a massive question mark on it, and it seems highly unlikely we'll see any update at all until at least when after the general election's been held.
Yeah, so that's really interesting. Dan, have Labour had anything to say on NatWest and the share sale at all?
It's not really clear if they would want to go ahead with it. I guess the key thing here is that it's an easy way to raise some money. So, I mean, if you just took a 10% discount to the current market price as a potential scenario, that would raise the government 6.5 billion approximately. I think, if Labour were to win the general election, they're probably looking for quick wins like that. Finance is quite important, to put it mildly, and as much money as they can get from quick wins, I'm sure that would be an easy one to do. But yeah, it's not perfectly clear at the moment what's going on. But just before we wrap up on the banking bit, let's just quickly mention about Nationwide. The company made 1.8 billion pre-tax profit for the year to the start of April. Whilst that was down by about a fifth from the previous year, part of that was to do with it handed out £344 million to its members last summer. Now, it's made an announcement saying it's got a new pot of money, £385 million, to hand out yet more money. So if you're eligible, you'll get £100 each. But as always, there's a catch, isn't there, for these things? There's a few conditions you have to meet in order to qualify to get this money. You've got to have a Nationwide current account. You've got to have used your current account early this year. Now, you must have also had savings or a mortgage with Nationwide in March this year. So if you qualify, you'll automatically get that payment in June. But just watch out for any scams asking you to apply, because clearly we live in this sort of horrible situation where scammers will just keep scouring the news and think, okay, anything here to sort of I can pretend to be someone, and this cries out for an obvious one where there's a risk that someone could say, so you might receive a text message saying like, oh, would you like £100 for free? Just fill out this form. But just if Nationwide is saying you'll automatically get it if you qualify, it means you don't actually have to apply. So just be really careful if you do get any messages like that. And also just remember that this payment will be treated as savings income. So you will have to pay, you could have to pay tax. So think about that from your tax planning as well. Blimey, I sound like a financial advisor, don't I? That's probably quite a good segue into our next segment.
Yeah, absolutely. So kind of moving on to some more personal finance stuff. And the financial regulator, the FCA, wants to see more people enjoy the benefits of investing. And they're particularly concerned about people who've actually managed to save a decent pot up, but are leaving it all or mostly in cash. And there's a concern that's because they don't know where to turn to start investing or what help is out there. So at the end of last year, together with the government, the FCA published proposals aimed at helping more people get help with their finances or closing what they call the advice gap. Now, to help us understand what on earth is actually meant by the advice gap and what changes might be coming and how they might impact DIY investors, I spoke to Ben Hampton, CEO of advisor technology firm Wealth Wizards. Hi, Ben, and thanks for coming on the show.
Hi, Charlene. Thanks for having me on.
Great. So to get us started, I want to ask you, when we talk about an advice gap, what is it you actually think people want and why might they feel it's not available to them at the moment?
Yeah, no, I think it's a phrase that's bandied around a lot. And I think the key thing I would say is you'll have listeners that do their own investments, sometimes dip in and out of getting financial advice, sometimes look for a bit of information on the internet. And actually, the way I would describe it is it's a help gap, right? And various stages in our life, regardless of the decision we're making, whether it's financial or otherwise, sometimes we just want a little bit of extra reassurance. And financial advisors are brilliant at giving that kind of peace of mind, but also expert recommendations. But one of the challenges is not everyone can access financial advice because it might not be affordable, might not be available. And even the people that might be able to afford to pay for it or want it might not just be able to know where to go. It's quite tricky. Wait, how do you pick a financial advisor? And it often comes from a recommendation from someone you know. So I think this is really a help gap. And I think the reason I use the word help is a lot of times people just want a bit of reassurance that the decision they're trying to do or make isn't bonkers. And, that's really what it is. You just want that confidence that, I think I've weighed things up. I think I'm going to do this. Does that sound okay to you? And I think if we can get to a point where that's there, actually, I think that will help a lot of people to have more confidence and engagement in the finances, which is a good thing. I think there'll always be a role for financial advisors because they have a fantastic service. And it's, if you've not had financial advice before, it makes a huge difference. But yeah, really for me, the help gap is around giving people the confidence to act and some form of support that's maybe not as deep as full financial advice, but effectively says what you're doing isn't bonkers and vice versa can stop you if it is bonkers.
Yeah, absolutely. I like that, the help gap, like you say, because I think the FCA pulled out a stat saying 8% of people in the year they were looking at got full financial advice, what I call full FAT or financial planning. But like you say, it's actually just that reassurance and am I doing something that's bonkers or am I okay? So yeah, no, really, really like that kind of reference to the help gap there. So what would you say people, in particular DIY investors, so if we're moving from that bit of help, when should they consider speaking to an advisor or a financial planner?
Yeah, so I think the way I think of the difference between financial guidance or financial information, which can be quite generic, it really lays out what you could do. As you move into the world of financial advice, it lays out, is personalized, and therefore it lays out what you should do. There's a gap in the middle, which is really about almost someone saying, you probably should. And I think that's quite a difference. It's not got the cast iron gold standard that financial advice has, but it's, again, that gives you that confidence to do it. And I think it depends on every customer, right? I think the biggest thing I would say is consumers have got more complex decisions to make. As you come up to retirement, tax rules can change. You might want, in the best will of the world, we don't all need to be experts on tax rules about pensions. I wish everyone was as passionate as you and I about this stuff and throws the duvet back in the morning, but they've got more exciting things to be doing in their lives. But you can kind of outsource some of that aspect. But also it's when you're making those trade-off decisions. Some people, retirement's the obvious one. Some people coming up to retirement, actually, there might be choices. It might be like, well, look, actually, you can afford to retire. Now we've looked at your whole financial picture, maybe your partner's situation as well, if you've got that in the mix. Would you like to retire earlier if you could? And that kind of question from a financial advisor can be, I've listened to calls and seen people do these meetings. The pitch of the voice of the person changes because they're like, I didn't realize that was possible. And it's how you can kind of get them to trade off these almost decisions in 3D or 4D, because it's not as simple as, do I retire now or not? It's, you could retire in this way or that way. And then vice versa. Some people can't afford to retire initially, but having that conversation where they say, look, what if you went part-time work for a bit? Would that work for you? And actually that might unlock that little bit of extra income until you maybe get closer to the state pension age, and it can unlock those things. And I think it's the ability to also learn from other people in other circumstances. A financial advisor, like a doctor, sees people making these decisions day in, day out. How do you help go and tap into that going, I've seen a case like you last week. Now, we're all individual and we're all irrational and all that type of good stuff. But that ability to get that emotional connection and the bit of coaching an advisor can give, and it's financial planning, right? It's not financial advice, it's financial planning. That's the really powerful bit of all of this.
Yeah, so kind of focusing in on needs and wants. And yes, obviously the maths and the sums and the tax and all the rules are really important. But yeah, taking a step back and kind of asking those big questions that I suppose many of us sometimes avoid as well.
We do. We stick out, it's ostrich. We stick our heads in the, you understand why, right? And lots of research you see is people say things like, well, look, got to retirement, I'll cut my cloth, because they think that's all they can do. And again, if the regulator can help have a little bit more, I suppose, actionable help from some of these proposals they're looking at, it gives people to make confidence, maybe explore a little bit further. I actually believe if we could help customers more, some of them might say, actually, I would value upgrading and I would value speaking to an advisor, because now I feel that there's a bit more decision to this. Before I thought it was, do I take my tax-free cash or not? I didn't realize that I could take part of it and what impact that might have and all things like that, without going into too much detail.
Yeah, and just kind of focusing in on what you guys see and what you do in the firms that you work with. Are those the main reasons for people getting advice now? And has anything changed sort of before and after the pandemic in your view?
So we're an unusual firm because we have a financial technology business that we kind of trying to make financial guidance and financial advice digital. The world isn't getting any less digital. Digital should mean convenient and put the control in the hands of the customer and the consumer. Mm-hmm. So we're kind of doing that, but we also have a small IFA business as well, which then uses our technology. So we get to speak and listen to customers every day, which is so important. I think the world is uncertain. It's volatile. Investment markets are going up and down, but it comes back to what you're trying to achieve. And I think that's really where that planning bit comes into it. So retirement's a big focus, as you'd expect. Actually, how you kind of get an always-on type service rather than actually, I'll just see you once a year. How do you check in and make that plan live? It's almost like a living plan in retirement. So look, retirement's the focus. People, as you know, I think, I haven't spoken about the pandemic for a long time, but everyone made their Zoom debut or their Teams debut in that period. So some things are just much more common that people are prepared to give technology a go. We've got to make the technology work for the consumer, right? It's the technology isn't the thing. It's just a way to make a better customer experience. And that's all the way I think about it, is get better experiences, better value for the end person in the UK, and that's going to make a massive difference to them.
Yeah, and I guess the more people seeing and feeling and experiencing that value from advice will hopefully kind of lead to more recommendations and more people getting the benefit of it as well. So moving on to the proposals from the Treasury and the FCA. So these are joint proposals as well. It's not just something coming from the regulator, very much being driven by government as well. Could you just give our listeners sort of a quick rundown of what they are?
Yeah, so look, conscious it's not a technical audience at times, or there's lots of people that know lots about pensions and investments. 3 proposals. So at the minute in the world today, you can either get something called financial advice, which we've said is get a recommendation on what you should do, or you can get financial guidance, which is effectively a series of generic options about what you could do. So they're trying to clarify what's the difference between those 2 different regulatory regimes. People or providers are sometimes a little bit scared to kind of trip into the wrong line of what's called the boundary between those two offerings. So trying to clarify that is one proposal. The third proposal is around, is there a new form of simplified advice, which is financial advice today, but maybe delivered by people with lower qualifications because it's for simpler needs. So again, lowers the cost of delivery. Still to be debated about if that's going to make the difference, or will things like technology just surpass that anywhere. But the middle box is the really interesting one proposal too. It's about this new form of more actionable guidance, something they've called targeted support. And it's got a lot of headlines because it talks about people like you, right? And that's the headline. So it's like Netflix. People like you do this typically. It comes back to that bucket of you probably should. It's not guaranteeing that's definitely right for you, but based on people in your target market, for a technical term, people that have these similar characteristics, actually, this is a sensible thing to do. And it's based on a little bit of sound financial planning principles. So you're getting a bit of a mix. But what they're trying to do is if you could put that in the middle, does that give access to help that just people can't get today? Because if it's too generic, we're all ostriches and we stick our heads in the sand and we leave it. And actually, if we get financial advice, people typically really, really value it. But that jump to getting it is hard. If you get this piece in the middle, it makes a smoother continuum of support. That spectrum is more gentle and it can allow you to move up and down. I think all of us in all our lives, we want different types of support at different times. We don't just go, we're all getting one type or a very in-depth support for everything. You'll mix and match, even if it was decorating your house. You might do the painting on the wall, but you might not touch the electrics. And it's that different stuff. Whereas someone else might go, I know I'm an electrician and I'm going to do all of it. But yeah, you get the poor analogy, if you see what I mean.
Yeah, no, thank you for that. So in terms of changes sort of investors might see, is it their provider might have some more tools available for them to kind of plan through their retirement, if you like, if they're not going to go for that kind of full financial planning experience? What do you think people might see if those targeted support changes do sort of come in?
Yes, I'd hope they're coming. So I think everyone's agreeing there's a gap, right? And I think everyone's got the will, and the fact that Treasury and the FTSE, the regulator, are working together, it's great. Obviously, we're heading to a general election, but regardless of your political view, I think helping people to make better decisions with their finances is a good thing, regardless of your political persuasion. So yeah, I think it will take a little bit of time. So it might be until 2026 until the rules come into play. But what you will start to see, I believe, is providers, whether you're investment platforms, whether you're pension providers, whether it's your workplace pension, I think people will start to offer, and it will be digital because that's how you reach scale, more of these engaging experiences that kind of take some of your personal information, apply some kind of rules and financial planning principles to narrow down what are sensible suggestions. Now, I'm using the word suggestion rather than recommendation, because a recommendation is, again, what you should do. A suggestion is still the choice of the consumer. But if they can narrow that down to, one or two options, that's better than at the minute when it's actually a very informative blog and you guys have loads of content, whether it's this or it's the stuff on the website, newsletters and things like that. It's really informative, but it doesn't narrow it down for your circumstances. So the onus is on the customer or the consumer to cut through that and make the connections. And as we've said, some people love this stuff and are interested in it. Others just want someone to say it's not bonkers. And I think that's the way it can do it. So yeah, I agree. Digital tools will pop around. And what you might start to notice if you're a discerning user of these tools is they start to become a bit more relevant and actionable. I think that's what we'd see. And hopefully that means people can take good outcome, get good actions, that make them get better outcomes with their finances.
Thank you so much for joining us, Ben. That's all been really, really useful. And thanks very much.
Thank you. No, likewise, it's been fun. Let's see what happens. But look, we just want customers to get good decisions with their finances. And I think that's something we all should strive for as the industry. And, we've got a responsibility to do it.
Absolutely. Thank you.
So that was Ben from Wealth Wizards.
Yes, and we promised you 3 chats and interviews. And third and finally, but definitely by no means least, Martin Gamble and Tom Sieber from Shares Magazine have joined us to discuss one of the UK market's leading lights drug company, AstraZeneca. They talk about how it's left rival GSK for dust and the ambitious new targets set by long-serving CEO Pascal Soriot.
AstraZeneca is one of the largest companies on the FTSE 100 and has at times been the largest. The pharmaceutical company may be most familiar to those who don't follow the sector closely for its COVID vaccine. But as we'll discuss in brief detail, that's actually not a particularly important part of the business anymore and wasn't in the run-up to the pandemic either. The company is definitely one of the UK market's shining lights, and it recently announced an ambitious plan for future growth. So, Martin, could you tell us a little bit more about this new strategy?
Well, it's not really a new strategy. It's an updated continuation of the existing strategy that was implemented when Soriot took over as CEO back in 2011, I believe. And he it was the first kind of long-term vision that the company had had in years. And he wanted to achieve revenues of more than 43 billion by 2023, which they achieved. So what they've done now is they've had another investor day and come out with some new targets, which are potentially even more aggressive than the original targets back then. So they now want to achieve 80 billion of revenues by 2030 and deliver a core operating margin in the mid-30s percentages, which is more than they achieve today.
Sure.
And relative to what analysts had penciled in ahead of this, and remember they were anticipating that Astra were going to update positively their growth outlook, but even so, they're short. So the new target is around 25% above consensus forecasts as they sit today. So that's what they've said, and it's more of the same, and not just from their existing portfolio of medicines, which is quite impressive, but from around 20 new medicines they expect to put onto the market by the end of the decade. So that's what they said in the recent update to investors.
So presumably those new medicines are ones that are already in development, that they kind of are already starting to progress through the various stages of research and approval.
Yes, they're a long way through that. In fact, I think last year, 2023, they had 30 compounds in late-stage clinical trials. So they're very close to marketing these new drugs if they get approval from the regulators.
So it's obviously under the current CEO, they've had a very successful period, and they're very ambitious for the future. I mean, one of the most striking things, I guess, since he took over is the fact that they've completely left their main counterpart on the UK market, GSK, for dust. So what has AstraZeneca done so well? And, perhaps could you draw a bit of a kind of comparison with GSK and why they've not been able to keep pace?
Yeah, the comparison is stark, isn't it? I think over the last 5 years, AstraZeneca shares have doubled and GSK around 12% ahead. So there's a big differential there. And, GSK has had its own troubles, and they've had activists on the share register now for some time trying to improve their operations, trying to improve their focus. Whereas Astra's quite a long way ahead of them, really, because when Soriot took over, he wanted to rebase the culture of the company towards what they called sort of expertise in different scientific areas, which he believes is like the basis for future commercial success. And so they did that. And actually, in the first few years after he took over, revenues continued to decline as products went off patent, and the revenues declined. But he predicted by 2017 they would start to grow revenues again through all of the research they were doing into new compounds, specifically in cancers. So they've got a large expertise, a large portfolio now in different cancers, and that's starting to come through. So that's really their expertise is in actually generating new products from research. So just to give you one flavor of it, before he took over, they had around 4% of their compounds that they were researching would make it to late stage. There's basically 3 stages, roughly: stage 1, stage 2, stage 3 clinical trials, and roughly around 4% of their compounds would make it through to the last stage. And he took that from 4% to around 20% over the next 10 years. So he's really improved the productivity and the science they're doing at the company. And I think a lot of other companies have kind of taken note, including GSK, and they're now trying to rejuvenate their own cancer pipeline under their existing CEO.
That's interesting. Yeah, I mean, you touched on it earlier, but this kind of concept of the sort of patent cliff and kind of patents expiring and not being replaced. I mean, that's almost the kind of key thing to get right as a pharmaceutical company, I guess.
Yeah, it's crucial. I can't think of a pharmaceutical company that doesn't go down the patent route. But of course, once you do that, you reveal what your secret sauce is.
Yeah.
And then it takes a number of years to get the product on the market by convincing the regulators that it's safe and effective, by which stage you've only got a few years left to generate the revenues that you can, because you've got pricing power once you've got these patents. It protects you from that. But, Astra has assembled one of the most diverse drug portfolios in the industry. And they've got around 12 what they call blockbuster products or drugs on the market. So blockbuster is a drug that generates more than $1 billion revenues a year in sales. And in the recent update to investors, the company said that they think that around 15, I think they said 15 of their drugs in development, they expect to have peak revenues of more than $5 billion a year. So they're very ambitious, but they've got an already diverse drug portfolio from which they can then target their future revenues. So they seem pretty well placed relative to competitors in that regard.
And how much of it have they sort of developed themselves, and how much perhaps have they added to the portfolio through acquisitions?
They were acquisitive. I mean, they made a very big acquisition. Was it 2021, I think, or 2020, late 2020, Alexion, which is a rare diseases company in the US. They paid $39 billion to buy that portfolio of potential drugs. It only had $5 billion of revenues at the time. But that's now a core kind of component of what they have in-house. Around 17% of their total revenues come from rare disease drugs. So yeah, they've got a fairly good setup relative to the competitors, I think, in terms of what they can deliver over the next few years.
And one of the things that sort of preceded Swara taking over was Pfizer coming in with a bid, and the fortunes of those two companies, I guess, have diverged as well quite significantly, haven't they? I mean, do you think, obviously a lot of UK companies have been targets recently. Do you think there's any scope for AstraZeneca to be a target, or is it kind of in a strong enough position that it's not that vulnerable to a bid?
It's more likely to be the acquirer. I think the general consensus was that these new targets, this 80 billion of revenues by 2030, will be achieved organically, but they didn't necessarily say they weren't going to make acquisitions. And they have done in the past, and they've also done lots of joint ventures as well with other companies where they basically buy in the products and they jointly commercialize the science and then share the revenues, the royalties. So that's again been part of their strategy. They're not necessarily just looking at their own internal capabilities. They're also looking to partner with other companies that have specific scientific knowledge which they can use through their own network of sales.
And is there a bit of a kind of succession risk? Obviously, the current CEO has done a very good job. Presumably he'll stick around to deliver these new targets, or at least that's the plan. But is that something for investors to watch and for the company to sort of have to manage?
It's certainly a good question. He's been there a long time, which is unusual for a large FTSE company in terms of its corporate governance. But arguably, he has done a decent job. But then there was a big furore, or whatever you want to call it, around his pay increase recently. And quite a few shareholders were against him increasing his pay to around £18.7 million a year, which would make him one of the, not only the best paid FTSE CEO, but relative to peers in Europe and the US, he would be, he's up there. So, but as to his longevity, that I'm not aware of anyone questioning that he's about to leave soon. As you say, if you set a target, presumably you're going to hang around long enough to try and deliver it, and then get paid out on the options and all the goodies that come with it.
Absolutely.
So that was Martin Gamble and Tom Seaver from Shares Magazine. So thank you very much for joining us. That's all we've got time for this week. Don't miss next week's podcast. We've got Richard Staveley from Rockwood Strategic Investment Trust to talk about small caps. That should be pretty good. He's had a really fantastic performance in recent years. So make sure you don't miss that interview. Thank you very much for listening, and we'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.